You spot what looks like a reliable entry. The chart prints a clear bounce, the trend looks secure, and you click buy. Seconds later, a massive red candle shatters that exact level, triggering your stop loss before the market reverses back up without you. This is the specific frustration of the current market. Traders enter long on a textbook value area low, expecting it to act as a floor, only to be stopped out by a sudden, violent downward wick. When thousands of traders place their stops at the same obvious support level, they create a dense pool of sell orders. Market makers use this concentrated liquidity to fill their own orders, essentially turning retail long positions into exit liquidity. While the surface price action suggests consolidation, the underlying distribution of buy and sell orders shows smart money positioning for a flush to the downside. Large players have already placed limit orders at a specific dollar value below the current price, waiting to absorb the panic selling that follows a support break. Surviving this environment requires moving past basic price patterns and strictly analyzing the order flow driving these liquidations. Bitcoin's recent movement illustrates this mechanic. After a push to $77,400, the price faced an immediate and heavy rejection. This ABC correction is MAC here. Bitcoin reclaimed the value area low, signaling strength, before testing the value area high at the golden Fibonacci ratio. Here, price hit a cluster of resting orders, triggering an immediate 2.5% reversal. The Cumulative Volume Delta, or CVD, measures net buying and selling pressure. As Bitcoin tested resistance, we saw a sharp upward spike in market buying. Simultaneously, the open interest indicator, tracking active futures contracts, showed a massive surge. A sharp rise in both CVD and open interest at a structural boundary indicates that new retail money is aggressively longing the asset, often at the exact moment the trend is about to shift. Order flow data suggests that when the retail majority aggressively longs the same support level, the probability of a liquidation sweep increases. This 3-day liquidation heat map highlights the next target. A massive concentration of leverage positions sits at $76,800, the most likely zone for a downward sweep. Zooming out reveals a secondary liquidity pool at $73,600, marking the origin of the larger rising wedge. This structural support is effectively a source of liquidity for market makers looking to drive the price lower to fill their own larger positions. These localized crypto sweeps are possible because major institutional capital is currently focused on traditional equity markets. Large hedge funds are managing extreme volatility in legacy tech stocks, rotating capital quickly to capture shorter-term gains. For instance, Intel recently pumped nearly 30% in a single day, before quickly retracing by 4.5%. That is where the active speculation is currently concentrated. This volatility in the stock market reflects broader macroeconomic concerns that are causing capital to move more erratically. Geopolitical tensions are also a factor, particularly the blockades affecting global trade through the Strait of Hormuz. As capital flows toward tech stocks and macro hedges, trading volume in the crypto market has declined. This low-volume environment allows market makers to move the price with less capital, making it easier to trigger the retail liquidation traps we identified. Identifying the $76,800 target is the first step, but executing on that data requires a platform capable of handling rapid liquidity sweeps. When these flushes happen, they occur in milliseconds. Success depends on using an exchange with deep liquidity to ensure your limit orders are filled with minimal slippage. For these specific order flow setups, we use BingX to set limit orders at $76,800, positioning ahead of the expected volatility. Using the channel's link for BingX connects your account to our direct mentorship program, where we track and analyze these specific setups in real time. Subscribe to Crypto Whale Radar to receive these order flow updates as we identify new liquidity clusters. Beyond Bitcoin, the broader altcoin market is currently facing a specific bottleneck that is preventing sustained breakouts. This chart shows Bitcoin dominance approaching a heavy resistance zone between 60.5% and 61%. The 61% ceiling has held for nearly a year. Every time dominance reaches this level, it prevents capital from rotating into altcoins. Altcoin breakouts are unlikely to hold until Bitcoin dominance decisively rejects from this historic resistance block. We can identify the specific price targets needed for major altcoins like Ethereum and Solana to break out of this trap. For Ethereum, we are looking for a confirmed 3-day candle close above $2,400. That would validate a move toward the $2,800 target zone. Right now, Solana is dealing with a completely different set of technical constraints during this period of market chop. Solana is range-bound, but it is successfully maintaining foundational support between $85 and $86, which is critical for its long-term structure. Many retail traders are partly ignoring these technical realities in favor of a psychological theory, often called the extended bull cycle. Mathematically, the market is following the established 4-year halving cycle. Historical data from the previous 3 cycles suggests we are exactly where the timeline predicts we should be. This data contrasts sharply with the recent hype around zero-revenue meme coins, which often lack the volume to sustain their initial pumps. The Trump token is a recent example, losing 96% of its value from its all-time high, as hype was not supported by fundamental liquidity. Successful trading in this phase of the cycle requires moving away from speculative hype and focusing on mathematically proven liquidity setups. Navigating the coming weeks successfully requires a single disciplined approach to these conditions. Allow the market to process the current retail positions at the point of control, rather than entering into the chop. Wait for price to reach either the 76,800 liquidity sweep target for a long entry or the 78,400 resistance for a potential short. Executing the entry is only the first step in a successful trade. Without a calculated exit strategy, your unrealized profits can drain away instantly during the next sudden market sweep. To protect your gains, click the video on screen now to learn the advanced take-profit strategies we use to exit these volatile setups.